Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Welcome to my video series where we tackle the tough personal finance questions asked by Australian expats. Today, we're here to discuss what are the worst possible mistakes you can make during a market downturn or during the market volatility that we've seen as a result of COVID this year. So let's get into these mistakes. The first mistake that we see a lot of people make when it comes to a market downturn, there's a bit of volatility, the media starts getting negative, tensions are rising, there's panic on the streets, is pausing or cancelling their regular investment plan. Now, it's counterintuitive when you actually do the maths. We all love a good sale. We'd love to buy our home that we spent $1 million on for $800,000. But somehow when it comes to the stock market and mark-to-market investments, this logic seems to go out the window. Let's just consider a simple example. Let's assume that we're saving $1,000 a month and we're investing that $1,000 into ABC stock. Now we'll just assume for simplicity purposes that ABC is trading at $10 a share. So we put our $1,000 in each month, and at $10 we can buy 100 shares. 100 multiplied by $10 gives us our 1,000. Now let's assume it's the start of April, COVID's hit, the market's panicking, and ABC shares are now $5 a share. Should we stop our plan? Should we pause our contributions? Or is ABC still just as sensible an investment as it was pre-COVID? Well, if it's the latter, we can now invest our $1,000 and buy 200 shares. Double what we could invest previously. Nothing's really changed, but we're able to accumulate more assets at cheaper prices. So again, as long as we're well diversified, we're not trying to shoot the lights out with penny stocks, unless it suits your goals obviously, then why would we cancel or stop our contribution plan? If anything, we should actually be going the other way and bump it up, increase it, as much as we can afford to, as much as is sensible. So be sure to keep it smart when it comes to your regular investments and monitor what your investments are actually looking like. The second key mistake that we see a lot of people make when there's a market downturn is trying to pick the bottom, and even worse, getting annoyed when you don't. Now, let me give you a very simple example. Back when the global financial crisis hit, 2008, 2009, Wesfarmers shares went from $30 odd down to about $10.80. I think it was $10.79 from memory. Now I bought some at $13, I bought some at $12. I think I even bought a few at $15. Now, was I upset when they got to $11, $10.80? Sure, I was a bit annoyed that I didn't have more cash to go and buy even more. But the share price is now back into the mid or high 30s, even into the 40s over recent time. Do I really care if I bought them at 13, 12 or 11? The answer is no. The trick to investing, the key to investing, is buying quality assets at cheap prices. And as one of the greatest investors of all time, Warren Buffett, puts it, you should only invest in assets that you're happy to hold if the market was closed. So treat it as a private investment, and if volatility bothers you, perhaps you shouldn't be in the market, or perhaps you just shouldn't be checking the price every day. The third common mistake that we see investors making when it comes to a market downturn or a bit of volatility is changing their risk profile at the worst possible time. So let's consider a simple example. I'm 30 years of age, not really, but we'll just create a bit of a case study here, and I'm investing my superannuation with the plan that I'll retire at 65. So I've got 35 years, I'm relatively young, I can be an aggressive investor because I've got plenty of time to ride out that volatility. So markets will go up, down and sideways over that time, but in the long run, I should achieve a reasonable amount of growth. Now, what is the worst possible thing I can do? Well, let's assume we're at the start of this year, I've invested aggressively, my asset allocation is appropriate, and then COVID hits. It's April and my portfolio is down 35%. Now, for some people, they won't really raise an eyebrow over that. For others, it will throw them into a state of panic. Now, the worst possible thing I can do is to change my asset allocation to a more conservative one. Now, this would mean selling my equities, selling my shares and any property exposure in the portfolio, and adding more bonds and cash, so the defensive assets. Now, the issue here is that when markets recover, and in all of the crises that have taken place in the past, markets have recovered, is I'm not going to get that bounce back. Because I've reduced my equities, my growth exposure, which means that I won't get as much of a bounce. So what should we be doing instead when it comes to our asset allocation? First and foremost, make sure it's appropriate for our goals and make sure that we're comfortable with the level of volatility that we expect. The second key thing here is to review it regularly. So don't just set up your asset allocation appropriately at the start and never look at it again, but review it once, twice a year and rebalance appropriately. Don't get sucked into just going all equities or all bonds, putting all of the eggs into one basket, because what you'll find is that if your asset allocation is not in line with your risk profile and overall financial goals, you'll find that bad decisions are often made at the worst possible times, such as we've seen this year. The fourth common mistake that we see people make when there's a market downturn is spending more than they earn. Now, this is always a terrible idea. Let's not kid ourselves. We shouldn't spend more money than we make, but it can become exacerbated and create much more significant problems for us if we're doing it during a market downturn. So let's just explore this for a moment. If I'm spending more than I earn, and I have a bit of an investment portfolio, I have a few shares, some managed funds, some ETFs perhaps, that are invested, appropriately balanced according to my risk profile and goals, and I find that because of COVID, I've had to take a 20% reduction in my salary. Now, we were already spending as a household a little more than we were bringing in, and now that's 20% worse. So what will I do? Well, I'm going to have to dip into my investments, which have already dropped as a result of COVID to lower than the purchase price or lower than they were last year. So you can start to see that these problems can actually create a bit of a snowball effect by spending more than we earn. So review this regularly. If you are spending more than you earn, start to look for ways to cut your expenses or increase your income. The fifth and final common mistake that we see Australian expat investors making during downturns and periods of volatility is FOMO, fear of missing out. We talked to our friend, taxi driver, our colleague. They bought this great stock. Of course, we never hear about the losers. And the stock's up 5 times, 10 times, 100 times their money. Why on earth didn't we find that? What if we'd invested and we start almost spending this money that we don't actually even have? And it often leads to very poor long-term decisions. Now, it's always important when it comes to investing to invest sensibly, buy quality assets at cheap prices where possible, and set target prices for both buying and selling your assets if that's part of your long-term strategy. Don't get sucked into buying assets. Don't get sucked into buying things that are beyond your risk appetite, because again, you may find that some fairly poor decisions are made in future as a result of those decisions that you make now. Now, I hope these 5 tips or 5 common mistakes to avoid have been helpful. I hope they've shed some light on some investor behaviours during periods like COVID and the volatility that we've seen. We don't expect the volatility to be disappearing, at least for the next 12 to 18 months. But if you have any questions at all about your own investment mix, what you should be doing during periods like this, fire them through. We'd love to hear from you, and maybe we can even turn them into a future video. Thank you again for tuning in, and I look forward to seeing you next time.